Hello, everyone. Okay, so with the topic that we have been talking about, which is cost of capital, right? I just want to, um, I would like to just share a particular, solve a particular question, right? And share it with you and show you how um, this type of question in cost of capital can be solved. Okay, well, I just want us to get familiar with areas which I examiner can test, ICANN or ACCA, and how we can try to see into their line of thought or thought process just to know that, okay, it is possible for them to set the question in this direction or follow another direction, all right? And it will also help us to think whatever is possible, all right, that we have never seen in their question before. So that it won't look like that is why I don't want us to encourage cramming. Understanding of the principle is key, and which is why I love to solve as many questions as possible. All right, so this question right here, it's actually a question from ACCA. As you can see on the screen, it is a question from ACCA. ACCA's financial management is called advanced management. That is their P4 paper. All right, and which also can be used to prepare for ICANN exam, SFM, even financial management exam, skill level the I for ICANN. Okay, this question is a sample question from ACCA released December 2021. Okay, this is an extract from their sample question, and I would just love to share the solution of the question with you. And the name of the question is called Zichi code. So I will like to tag this video solving Zichiko question. All right, good. Now, going back to coming to the question, you can see the question is a question that has long story. Okay, it has long story, and excuse me, the question has long story. So I would show you how this question can be solved one after the other. Coming to requirements straight away. Okay, so coming to requirements. Now, requirement says discuss and justify the action Zichiko should take. Requirement A, discuss and justify the action Zichiko should take to address the three financial strategy policy failures. Okay, that's question A. Then question B speaks about prepare, says prepare a report for the board of directors which estimates an appropriate discount rate to be used, appropriate discount rate to use to determine the net present value of the new project based on all equity finance. Based on all equity finance. So I'm going to stop here and reading the requirements because for this video, I just want to show you how to calculate discount rate because we've been talking about cost of capital, and that is what requirement B Roman figure 1 is saying. All right, that so we are only for this video we are only going to touch requirement B Roman figure 1. So this is not the time we'll be talking about the reports. Maybe in another video, we'll talk about how we can write reports. Okay, now the question is, how do we calculate um, discount rates to be used for to calculate the NPV of the project based on all equity finance? That means the project is going to be financed only by equity, only by equity. Now, if the project is going to be financed only by equity, that means the cost of capital we need is going to be cost of equity ungeared. Cost of equity ungeared. All right, so very quickly, and capping has a way of calculating cost of equity ungeared. We could use capping and we could use Miller-Modigliani. So whether we are using capping or Miller-Modigliani or even dividend model, the question will let us know through the information we have from the question. But from here, we don't know if we can use Miller-Modigliani or capping to calculate it. But the information provided in the question would let us, in the story, would let us know. All right, let us go straight to reading the story now. Okay. I'll try to be fast in reading this story, and it's a long story. We'll read everything. Okay. Zichi, a large listed engineering company involved in the development and manufacture of the environmentally friendly products for business worldwide. Until a few years ago, the value of its shares had been increasing steadily, and it regularly outperformed its main rivals. However, more recently, its shares have been underperforming, and many financial analysts are recommending that Zichi shares be sold. Zichi investors are becoming increasingly concerned. Okay, the analysis concluded that this underperformance was due to three policy failures in the company's financial strategy as follows. Number one, Zichi does not undertake post-completion audit of its investment project. Number two, Zichi has used a fixed discount rate of 10% to assess all investment projects for some years now. None of the company's senior management can remember why this rate was chosen. Lastly, and Zichi has continually funded new investment projects using equity finance, and the analysis concluded that this financing strategy sets the wrong signals to investors. Okay. Zichi is considering a new project to manufacture environmentally friendly motor scooters, which are fully carbon neutral. This is a diversification into a new business area for Zichi, in which it has no previous experience. Zichi chief financial officer is of the opinion that Zichi should determine an appropriate discount rate for the project on an initial assumption that the project will be based on all equity finance. Liu would be a competitor to Zichi as it manufactures environmentally friendly motor scooters as well as equipment for wind farm. Approximately 60% of Liu business is manufacturing motor scooter, and the remaining 40% manufacturing wind farm equipment. Given below is most recent financial information relating to Liu. Okay, share capital 25 cents nominal value, reserves market value of equity, market value of debt, equity beta. Sanwen-Yu Co. is involved in the manufacture of equipment for wind farm. It has estimated its cost of equity as 15.4%, and it is financed 20% by debt, 80% by equity in market value terms. The estimated risk-free rate is 4.8% and the market risk premium is 8%. The corporate tax rate applicable to all companies is 20%. The corporate tax rate applicable to all companies is 20%. Zichi Co. expects the new project manufacturing environmentally friendly motor scooter to last for 4 years. The project will require an immediate expenditure of $70 million for plant and machinery. After the project ends in 4 years, in 4 years' time, it is anticipated that the project will be sold for $42 million, inclusive of any inflationary increase. The following estimate of revenue and cost relating directly to the project have been made. In the first year, sales revenue is expected to be $10 million, and which increased to $40 million in year 2. In final 2 years of the project, sales revenue will grow by 20% each year. Cost is estimated at 120% of sales revenue for the first year and 80% of revenue for the second year, before reducing to 40% of sales revenue for each of the final 2 years. Substantial initial working capital of $10 million will be required at the start of year 1 of the project. Subsequently, working capital of 15% of sales revenue for that year will be required at the start of the year 2 to 4. Any remaining working capital will be released at the end of the project. Zichi Co. pays corporation tax every year. Tax is payable with a year's time delay, and any tax losses from the project are set against the company's profit from other projects. Tax allowable depreciation is available on the plant and machinery for the project at an annual rate of 15% on a reducing balance basis. It is anticipated that the plant and machinery will have a realizable value of $20 million at the end of the project's estimated sales price of $42 million. Due to the positive environmental nature of the new project, Zichi Co. can obtain the entire funding for the project through a loan at a subsidized interest rate of 180 basis points lower than the estimated risk-free rate. Zichi Co.'s normal borrowing rate is 6%. Zichi Co. has decided that the project should be entirely funded through the subsidized loan. Issue costs which need to be paid are anticipated to be 3% of the gross finance. Issue costs are not allowable as a tax-deductible expense. Given that the new project is to be funded by the subsidized loan, Zichi Co.'s chief financial officer is of the opinion that adjusted present value of the project would be more appropriate than the conventional net present value based on the risk-adjusted cost of capital to evaluate the project. However, it cannot explain why this should be the case. Zichi's board of directors is considering whether to raise funds for forthcoming project either through new debt finance or through asset securitization. In addition to its manufacturing business, Zichi receives rental income on some of its factory premises and its plants and machinery which it hires to other companies. The board is of the opinion that it should securitize this rental income. Okay, thank you very much. So we are going to requirement two, just only requirement two, which says we should requirement two requirement B1, which says estimate appropriate discount rate to be used. Now, when it's appropriate discount rate, now when we're reading the story, the question, it was taken from the question, it was given from the question that we have to that Zichico is diversifying. So Zichico is diversifying from what is doing before. So we need a proxy, and they provided proxy. Proxy is Liu Co. The proxy is Liu Co. The proxy is Liu Co. Now, I'm going to be solving. So the first thing is to identify proxy. When we identify proxy, if you look at Liuco, they gave us information of Liuco, and we have the market value of Liuco. We have equity beta of Liuco, and we have other information about Liuco, saying that Liuco does two activities, which is environmentally friendly motor scooter and equipment for wind farms. So those are the two things Liuco does. Now we are going to use Liuco to estimate what we call costs of capital. Now, looking at it from here, we have another proxy, which is called Sanway Yuko. So very quickly, let us go into solving this question. And when I'm solving, I may not be able to share the screen with where the question is, but I'll just be writing the solution. So I believe you all have this question, okay? And I believe you can access this question on ACCA website as well. If you just search for it, ACCA sample question, December 2021, you will find Zichi code there. And if you wish to have this question, I could send it. If you can't find it, you can reply, you can put message in the comment section, or if you have my WhatsApp number, you can request for it. I will help you get the question. Okay, all right. Now, let us go to solving the question. I switch to the board now. Okay. Okay, good. Now, so first thing first, all we need to do right now is to identify the proxy. So, and we get information about the proxy. First thing, the proxy, step one, to calculation of, I would say, calculation, that's what they ask us to do, calculation of appropriate discount rates, which is otherwise known as cost of capital. Cost of capital. All right. So now, for who we are doing this for Zichi Co. Zichi Co. That's the name of the company. So step one involves getting information about proxy. We are getting information about proxy. Now, we have two proxies, like I said. Now, the first one, and I will tell you why we have two proxies very soon. Okay, the first proxy was who? We have Liu Co. Liu Co. So what do we have about Liu Co? What do we have? Excuse me. So what do we have about Liu Co? We know the beta equity of Liu Co. The beta equity of Liu Co is equal to 1.2. We know the market value of debt of Liu Co. The market value of debt of Liu Co is 48 million $260. We also have the market value of equity of Liu Co, which is market value of equity, which is $172 million. We also have tax rates T, which is 20%. Okay. Tax rate, they said corporate tax rate applicable to all companies is 20%. Now, these are basic information that are needed. Now, other things about Liu Co that we have here, let's put them down. We were told that Liu Co has two activities. What are the activities? Liu Co is doing environmentally friendly motor scooter, and Liu Co is also doing equipment for wind farms. Now, I'm going to name them scooter and wind farm for easy for us to be able to call them easily. And so that I'm just going to identify the activities by scooter and wind farm. Now, approximately 60% of Liu Co's business is in the scooter. Now, the portion of scooter is 60%. Portion, let us note down one. Portion of scooter, portion of motor scooter is 60%. Let's note it down about Liu Co. The portion of wind farm, the portion of wind farm is 40%. The portion of wind farm is 40%. Now, any other information about Liu Co? We don't have any other. The other information are share capital and reserve. Those are book value information, and they are not needed for this purpose. And we were told that Liu Co has two activities: scooter and wind farm. Now, all we need is the beta assets of scooter so that we can use it to calculate the risk-adjusted cost of capital for the wind for the project that Zichi Co wants to do. Okay. Now we just need, now that we can see from the story that examiner gave us beta, it is clear that we are going to use capital asset pricing model to estimate this our cost of capital that examiner is asking for from us. Remember, appropriate cost of capital which is suitable for a project that is going to be financed through only, but that is going to be financed only by equity. That is going to be financed only by equity. And for now, at least that's what they mention in the question. All right. Although we read in the story that the project is going to be financed by borrowing. Okay. But they said we should do a cost of capital as if the project is going to be financed only by equity. So let us obey the instruction in that part of the question. Now, if we are going to get a cost of capital that is going to be financed by equity, now, like I said, it is shown that we are using capital asset pricing model. Why? Because they gave us beta. We have beta of the proxy, which is 1.2. All right. Now, how can you, if they give us cost of equity of LiUCO, for example, we are going to use Miller and Modigliani proposition 2 to estimate that. So since we have beta, that's why we are using capital asset pricing model. And in using capital asset pricing model, KEU is what we need to calculate because they already said we should calculate a cost of capital that is suitable for, or that is appropriate, or that is suitable for a project that will be financed only by equity. So the cost of capital that we need in this case is KEU. And whatever the KEU is cost of capital of an ungeared company, cost of capital of an ungeared company. And whatever the KEU is, that is what the WACC is. Remember, the company does not have debt. That's the assumption we got from the question. The company does not have debt. So if they don't have debt, whatever the cost of equity on geared is, that would be the cost of capital. So now, we only have beta of 1.2. The beta of 1.2 from LiUCO represents the beta of the company as a whole. It represents overall beta. That 1.2 is overall beta. Okay, so we can't say it is meant for wind farm or it is meant for scooter. So what we are trying to say, the beta equity of scooter and wind farm, they are inside that 1.2. As you know that beta equity measures business risk and financial risk. Therefore, beta assets that measures business risk is therefore embedded inside beta equity. So therefore, we are now saying that beta equity, the beta asset is embedded, all the beta assets, scooter and wind farm is embedded inside the 1.2. All right. So what we are now going to do is to bring out the beta of scooter that we need. Now, go to Sanwe-Yuko. Examiner said Sanwe-Yuko is involved in manufacture of equipment for wind farm. It has estimated cost of equity of this of 15.4. So let us bring out Sanwe-Yuko. Now, since Sanwe-Yuko do wind farm, maybe we can use Sanwe-Yuko to get beta. If we can estimate the beta of Sanwe-Yuko, all right? So from these questions, the only thing Sanwe-Yuko does is manufacturing of equipment for wind farm. So if we can get the beta equity or beta asset of Sanwe-Yuko, we should be able to use it for LiUCO, and we should be able to use it to estimate the beta asset for scooter through LiUCO. So let us note Sanwe-Yuko down. Okay, Sanwe-Yuko. So what we have here, Sanwe-Yuko, okay, Sanwe-Yuko cost of equity, Sanwe-Yuko KE is 15.4%. And we were told that Sanwo-Olu Co has debt to equity 20 in market value terms. Debt is 20%. Equity is what? 80%. Then we have risk-free rates, RF. We have risk-free to be 4.8%, and we have premium, market premium, risk premium would be 8%. Risk premium is 8%, and this information is applicable to all the companies in the question. They have general information. So what we have here, we can use capping to estimate the beta for Sanwo-Olu Co. Look at it, what's the capping? Because of the information we have. Now, capping, using capping to estimate beta equity. So what is the capping formula? Capping says KEG. KEG is cost of equity of a geared company, which is equal to risk-free plus beta equity market return minus risk-free, which is our risk premium. So fixing then, we already have cost of equity, which is 15.4%, equal to 4.8, which is risk-free, plus beta equity. That is what we are looking for. Premium is 8. Premium is 8. So we are going to solve for the beta equity. So we're going to have 15.4 minus 4.8. Therefore, we're going to have 15.4 minus 4.8, which is equals to 8 beta equity. Therefore, beta equity will be equal to 15.4 minus 4.8, divide both sides by 8. Therefore, our beta equity would be equal to, okay, I am trying to use my calculator now, 15.4 minus 4.8, that is 10.6, divided by 8. We have 1.33 approximately. So that is the beta equity. So this represents beta equity of wind farm. Remember, Sanwo-Olu Co is only doing wind farm. So now, since Sanwo-Olu Co is only doing wind farm, so from here, we are now going to ungear this beta equity that Sanwo-Olu Co gets so that we can get the beta asset of wind farm from here. Next thing, I am going to use ungear. So we now say ungear. Next step. Now, what are we ungearing? So beta asset formula. So when we are ungearing, we are actually, whenever we are ungearing, we are actually using beta asset formula, which says, a beta asset formula, which says beta equity times value of equity divided by value of equity plus value of debt 1 minus T. If you check everywhere in the question, beta of debt is not given. Therefore, the other side of the formula becomes 0. Okay? Because beta of debt is on the other side. Beta of the 0 times whatever is there is 0. 0 divided by whatever is there is 0. So that is why we are restricting ourselves to this formula alone. Therefore, beta asset equals to beta asset equals to 1.33, which is beta equity. The market value of equity of Sanwen Yuko is 80% divided by 80 plus 21 minus tax. Tax is 20%. So what do we have? Then we have 1.33 multiplied by 80, okay, equals to this, divided by, open a bracket, 80 plus, open a bracket, we have 20 times 0.8, close the bracket. Okay. Now, so what we have is equal to 1.11. That is the beta asset of, this is the beta assets, the beta assets of wind farm is 1.11. Now that we have gotten the beta asset of wind farm through Sanwen Yuko, you know that Lee Yuko, who is the main proxy, it produces equipment for wind farm. Now, we are now going to use this 1.1 to estimate 1.1, which is the beta asset we arrived from Sanwen Yuko, to estimate the beta assets that we want. Remember, the beta asset we want out of this question is the beta asset of motor scooter. Is the beta asset of motor scooter. And Lee Yuko does motor scooter and wind farm. But examiner did not give us information about Lee Yuko on how we can estimate the beta asset, wind farm or scooter through Lee Yuko. He now gave us Sanwen Yuko and made us estimate the beta asset through Sanwen Yuko. All right. So we are now taking this beta asset to Lee Yuko and use it to estimate the beta assets we want, which is for the scooter. So in the next video, we will demonstrate that. Thank you very much. God bless you. Cheers.